you talked a little bit about the accountability regime, and so I'm keen to understand from you how you're seeing organisations respond to BEAR. Is it in line with your expectations? What else could they be doing?
The BEAR's been a big initiative for major banks that came into play in 2018, for the smaller banks in 2019. We think it's been a very big positive. And it's not just coming from APRA. We talk to entities, and the message from entities is it's actually been a good process to go through and really nail down who is accountable for what. So that's been really good. Of course, there's always a trade-off with compliance, so you don't want to build something that's really a compliance exercise, and getting that balance right, we always have to be aware of that. In terms of what we've seen, one really interesting thing for us has been, it is a very big tool for APRA, and there's a lot of powers that go with that. But we do have some examples where we've seen something we're not happy with, and all we've done is really ask the question, who is the accountable person under the BEAR? And just asking that question has elicited immediate response from the entity without exercising any power at all. So I find that a very pleasing thing. But overall, very big net positive.
Oh, good. Thank you. So, Guy, we might move to you and talk a little bit about monetary policy. So with an outlook of lower interest rates into the longer term, do you feel the impact of monetary policy on the economy is diminishing? And do you believe that this is compounded by the way that the banks pass on the RBA interest rate cuts?
No and no would be the answer to that question. So despite many claims to the contrary, monetary policy, I believe, is still effective. It's possible it's slightly less effective than in the past, but it's absolutely still effective. We have seen its effect through the exchange rate works about as well as it ever has. Its effect on the household cash flows is about as best as we can tell, working about as effectively as it ever has. So the fact that households haven't adjusted their repayments down in the months immediately following interest rate reductions, that's been true for the better part of a decade. But still, over the course of time, households do reduce their interest payments. The fact they haven't done it in month one, after the banks passed it on 6 weeks after we reduced the cash rate, which is also what normally happens, isn't any evidence of ineffectiveness. It's something we're very much mindful of, but we don't, on the evidence we have, and we have a reasonable amount of evidence, we don't see anything different to what's happened in the past in terms of household behaviour in responding to low interest rates. It's probably one of the factors contributing to house prices, so that channel seems to be working about as much as it ever does. And then there is this other sector of the economy which borrows money, which is called the corporate sector, which is often ignored in this discussion. And while it may not necessarily generate an increased investment response, if you think about the small business sector, they also are seeing improved cash flow through lower interest rates. So through all those channels, I think monetary policy is working about as effective. We don't see any reason to suspect it's not working as effectively as it has in the past. One caveat to that is it clearly is having an impact on those who rely on interest on their deposits for their incomes. That's always obviously been true as we lower interest rates, but as interest rates gets to lower levels, that does seem to be potentially changing. The behaviour there may be changing some. That's something we're very much looking into at the moment. Just to put in context the effect, so we've reduced the cash rate by 75 basis points. So while the banks haven't passed on all of that to the standard variable rate, over the course of time, what we have seen is that people have refinanced to lower rates, so that by now, I think we're up to around 60 of the 75 basis points is reflected in the decline in average mortgage rates. By the end of the year, it may be getting somewhere closer to 65. And so that's because people are recognising, because there is a gap between the rate on the front book and the rate on the back book, people are waking up to that gradually and refinancing to cheaper rates. And so over the course of time, the pass-through of the cash rate to mortgage rates may not be much different at all than it's been in the past.
You talked a lot about remediation and remediation outcomes, and I think it'd be fair to say there is an incredible amount of focus on remediation within the industry at the moment. What's your view on how organisations should balance, getting to remediation, driving remediation, with also driving growth across their organisation as well?
Yep. Okay. So before I get on to the legacy versus the growth story, I think it's important that we remind ourselves of three things. I was doing a speech at the University of Melbourne last week, and I had a question from a gentleman in the audience saying, why are you focusing on the negative? This is only $10 billion of a market cap industry of the banks of, how many hundreds of billions. And it just sort of struck me that the metrics here tell us why it matters. We're not talking about hundreds of people or thousands of people or even tens of thousands of people or even hundreds of thousands of people. We're talking about 1.2 million, and that's just the beginning, because that was 670 million, and we know that the banks have actually provisioned more than 10 billion. So that's kind of number one that we need to realise. That said, so that tells us that Houston, we have a problem. But if you then look at it as it's all just a legacy and a sunk cost, I think the more mature financial institutions are actually realising that fixing the problem is part of the solution to growth going forward. The growth of the past, if you're playing with not dealing with non-financial risks, will crystallise into a financial risk event, as we've seen. That's number one. Number two is a lot of these institutions were sitting on what we would call toxic revenues. So to the effect that they couldn't identify the difference between a good revenue, a sustainable revenue, and a toxic revenue meant that the boards couldn't identify whether or not. So for us going forward, after having gone through the process of remediation and making sure that you've got your systems right around complaints handlings and breach reporting, all of that coupled with what's good business sense under the design and distribution obligations means that the growth story will be a sustainable growth story and a good consumer outcome story. So for us, it's not, don't view it all as legacy, view it as informing the growth path as well.
And do you have a view of how long you would expect that to take?
The remediation
or I guess as we move from remediation into growth, a broad view of, do you see that as years? Do you hope that's more like months?
No, the boards that we're speaking to, they're managing both. And it is a huge task that they're juggling. But those that are doing it in a mature way are those that are, in doing the remediation and getting that right, they're using that to inform what the growth path is. And the best example is product simplification at the moment. I mean, that for me is a real game changer post Royal Commission, because that unnecessary complexity meant that it was very difficult in and of itself for consumers, but also difficult for the entities to be able to identify which products were of value to a consumer versus which were of surprise value to a consumer.
Agree. So along those lines, we might move to regulating culture, John, just a small topic. And the industry is grappling with how to address the cultural issues highlighted through the self-assessment report into CBA. And there's a lot of debate about how to measure and monitor culture and how to identify practices that appear at odds with your culture. Why do you think organisations find this so difficult?
Well, it's a good question, Nicole. I think they find it difficult because it is difficult. Like, as a leader of an organisation, I mean, you need time, you need to be pretty determined, you need to be persistent, right? It's going to take a while and you need to be determined to actually make it happen. I think it's hard because organisations have to do it. Like, the board, the executive are responsible for the culture in the organisation. So they have to do it. Where the regulator comes in is where we see, say, poor risk culture, and we will probe boards, and if we're not happy, we will take action. But ultimately, really, responsibility lies with the entity. When you look at what we saw with the self-assessments, so we had a rich set of data, 36 self-assessments came in, and that gave us some insights a bit on why institutions find it hard. So, when you look at the diagnosis of issues, some institutions, or in fact many institutions, would rely on one data source to try to assess culture. They might do a survey, right? So, but in reality, there's actually a lot of cultures, right, in an organisation, a lot of ways to kind of gauge it. So a bit more of that on the diagnosis. And in terms of solutions, sometimes we saw, entities would come to a diagnosis, come to a solution, but a lot of the solutions were focused around systems, processes, rather than attitudinal change and cultural change. And so, you've actually got to diagnose the thing well, and you've got to have a set of solutions that are fit for purpose. And maybe if you can achieve that, then it'll feel a little bit less hard than it does.
Yeah, thank you. So in your role, do you find it pretty easy when you're talking to boards and executive teams to work out, what the culture is and where you need to be worried?
No, we don't find it easy, and our job's not to feel easy about it. In fact, I hope when we go in, boards feel we're being a bit intrusive too. So we'll be asking tough questions of the boards in terms of how they think about culture. What is the culture? What is the remediation plan to the extent they've identified issues that need fixing? And how can they be convinced from management that they're on the right track in a meaningful way? And that's how we do it.
Yeah. Thank you. So this will be my last question, and then I will open up, so be ready. So Guy, staying with the theme of interest rates and a low interest rate environment, what are some of the risks that you can see arising from a low interest rate environment? You talked a little bit before. And what would you need to see in the housing market to be concerned?
Okay, two slightly separate issues. One I mentioned earlier, obviously there are a number of people out there who rely on deposit income. So if interest rates are lower for longer and they are unwilling or unable to switch to any other asset or even run down that asset, then that's a clear issue for them. One thing I'm not particularly worried about a low interest rate environment is its effect on bank interest margins. I'm not sure whether some people have the incentive to talk their own book to preserve their interest margins and complaining about low interest rate environments. But one thing, I mentioned it in my talk. So one, I think bank interest margins in this country are actually reasonably healthy. Well, they are absolutely healthy. Secondly, low interest rate environment it has an impact on asset quality as well. So it's not just about interest margins. It has an impact on asset quality, which is a first order impact on the profitability of financial institutions. And I think that sometimes seems to get missed in the discussion here. We are setting policy to ensure a strong Australian economy. A strong Australian economy very much benefits the asset quality of those who are lending against those assets. And I think that very much needs to be kept in mind. Related to that, on the housing market side, at the moment, house prices are rising, but credit growth isn't. As I mentioned again earlier in my speech, we are much more confident, mostly as a result of a lot of the stuff that APRA's done, about the overall quality of the credit which is out there. And so given that, for me personally, I don't think that's something we're a long way from needing to worry about that at the moment, given what we're seeing out there. There is some level of excess which would be a concern, but it mostly comes down to, are we confident that the lending standards are being maintained? And as long as that's the case, then I think that very much dilutes that risk.
Thank you. So that wraps up the panel discussion for today. So please join me in thanking Guy, Karen and John for their time and comments today.